to begin. Hello, everyone, and welcome to our bi-monthly economic and investment update. My name is George Lagarias. I'm a chief economist at Mazars. This time we will be joined by Santiago Rossi, who is our senior economist. And we will talk about all things economy and investment. As a caveat, to begin this conversation, I am from Greece, as you might have noticed from my surname, and Santiago is from Argentina. So in a world first, we will have a Greek and an Argentinian delivering economic and investment advice to people in Britain. Now, let's begin with the process. Since we last talked, the economy has now reached a pace where inflation is slowly falling, and it's reaching acceptable levels, not target levels yet, but acceptable levels by central banks, and growth is also slowing. So what is changing is this calculus of central banks. Since we last talked, and even 2 months ago, central banks were still fearing inflation more than they were thinking about growth, especially the U.S. Federal Reserve. The Fed is the world's de facto central banks, the de facto central bank, and what they say matters to markets, to all your investments, be it American or British. So we've reached a point where this calculus has now changed, and where the economic growth has become at least as important as inflation. So now central banks are debating not whether, but when they should begin rate cuts. Okay, this is a year of transition now towards a lower rate environment. And those of you who have been with us through some calls will know that this is also the point in the cycle, central bank loosening, that kicks off the next bull market, which may last for years. The cycle, not all pieces in the cycle are the same. Next slide, please. Now, as inflation began to drop back in late October, more convincingly, markets began a rally. It was for many reasons. It was central bank comments, it was inflation dropping, and there was a seasonal effect. At the end of year, usually we do see rallies, and because you have a lot of algorithms in the market, they tend to follow past trends. So past trends are actually reinforced. So since late October, we have had a very, very decent rally. Global equities, on average, give you 8% per annum. In these 3 months now, they have given you already 16%. Global bonds give you 3 to 4% per annum. In these months, they gave you 7%. It was as high as 9% at the end of December. So we have enjoyed a very, very, very good rally. Next slide, please. The S&P 500, that is the world's benchmark in terms of stock markets, is at an all-time high. So it breached the 40. It's now the 4,900 level, and this is its absolute all-time high. Next slide, please. Now, before we get all jovial about this bull market, let's pause a little bit. Let's take a breath, because this rally has also been very narrowly led by the tech sector and dominated by US stocks. So we did the chart, and if you take tech out of the equation, you have a very different picture. Since last January, so for the past 13 months, the S&P 500 is up 29%. But take tech out of the equation, it's only up 7.5%. Most of that difference was created until June, July last year, but it was it was a little bit reinforced in the past 3 months as well. So we have the tech stocks, the 10, 15 big stocks that rallied, and we have the rest of the market just waiting to catch up. So, a big question for markets right now is, should we bet on tech rallying more? Should we bet on the index because we do not know? Or should we bet on the rest of the S&P 500 finally catching up? It's a very difficult question to answer, to be sure. Next question. Now, those of you who have investments, except for equities, you have bonds in your portfolios. And although it has been really painful, especially in 2022, in 2023 we did see a very decent rebound in bonds near the end of the year, of course. And what we see now is that you get a very decent yield for investing in investment grade bonds, around 3.5%, 4% for bonds with duration around 7 or 8 years. Remember, in the past few years, you got 0, 1, 2% for investing in longer term bonds. And you had to take risks. You had to go to high yield just to get the 5. Okay, now, so you get that yield from the investment grade, and that is attractive for many people in the markets because they don't have to depend on stocks that now have a dividend yield of 2.5%, maybe 3%. They can depend on bonds to get the yield, which is as it should. This is a normalization process, and generally speaking, when longer term bonds have a yield, this also facilitates credit. If I can lend money to you for a long time and get something back out of it rather than the 0% or the 1%, then I'm more likely to give it to you. So we are in a process of rate normalization. This is why, by the way, the Fed will never return to the zero interest rate environment if it can help it, if there is no accident. They don't want this anomaly of zero yields because at the end of the day, it obstructed credit. Next slide, please. Now, what we had, and by the way, this was the reason for the rally, was that especially in the bond market, bond traders began to price in aggressive rate cuts. Make no mistake, they're still pretty aggressive. 15 January, so 15 days ago, in the US, they were pricing in 6.5 rate cuts this year. Now we're down to 5.5. In the last few days, we have seen a sort of adjusting for reality because the valuations and the rate cut expectations, they were really delusional. We are seeing in the UK now the market is pricing in nearly 5 rate cuts this year. And in the EU, the market is pricing in 6.5. We still think these projections are a little bit too optimistic. The market tends to be more dovish than central banks. They have a very different way of thinking, and markets really don't think. It's a lot of trading, and if the next person buys, then I want to buy because I want the yield. So I don't care what the macroeconomic implications are. I just want to buy because I want the yield, or I want the capital gain because I know the third person is going to buy, so I can sell them that bond at a good price. But we are adjusting to reality, and still there is a lot of adjustment to be made. Next slide, please. So the light blue line is quantitative tightening, projected quantitative tightening in the gray background, and actual quantitative tightening in the white background. And the thick blue line, you have the S&P 500. Those two were correlated for the past 14 years. But in the past 3 months, although the Fed keeps withdrawing liquidity from the market, the S&P, betting on aggressive rate cuts, has been higher. So to sum up the 3 past slides, what do we have? We have a narrow leadership. We have bonds effectively competing with equities because of their higher yield. And we have rate expectations which are still pretty optimistic, and the S&P 500 defying the gravity of quantitative tightening. So the long and short of it is we enjoyed a good rally, but until we see more from central banks as to when they're going to cut rates and how much, and more from the Federal Reserve, especially in terms of quantitative tightening, we cannot say that this is a bull market. A rally is something with a beginning and an end. A bull market is something that lasts for a very long time. So our base case now is that we're going to see more volatility until we have the end of quantitative tightening and convincing rate cuts, a lot of which are already priced in. So it's very difficult to surprise the markets on the upside. Going on to the next slide, and I know it's a very convoluted one, so I'll try to be brief. These are 12 key calls for 2024, which you can also find on our quarterly over the internet. Let's start with the things that we're more convinced about. One, there was a lot of talk last year about the world ditching the dollar. We don't believe that that is the case. We believe that the dollar will remain the world's reserve currency for a very long time. We're also pretty convinced that economies will exhibit a slowdown in the first half of the year, although the US, on the back of very high fiscal spending, seems to be defying gravity a little bit. There still overall, especially if you look at Europe, you are seeing a global economic slowdown in the first half of the year. Consumption, especially again around Europe, could slow down and unemployment will likely climb a little bit. Not much. We won't see any major labor market dislocations. Deficits will persist. Why? Well, in the US and in the UK, for that matter, we have elections. You know, the last thing you want to do is strangle the economy before the election happens. And we also see the lingering of geopolitical tensions. There are two major conflicts right now, one in Ukraine, one in the Middle East. And we do see the prospect that these tensions will go on for the foreseeable future. As we said, we do not see a sustainable bull market until quantitative tightening stops. We see inflation eventually stabilizing, except if geopolitical turbulence becomes too pronounced. And we do believe that quantitative tightening will probably end when rate cuts begin. We're less convinced about whether economies will recover in H2 2024. It could be slightly earlier. We have seen some very encouraging numbers from the US, or it could be slightly later if central banks are too afraid to cut rates. We simply don't know because that depends on central bank decisions. And in terms of more in terms of risks, we do see that something important for central banks may well break. Last year, it was US peripheral banks. We think that in the system, you have pockets of weakness, you know, companies or sectors that bet on interest rates being zero forever. So those business models are disrupted. We do believe that the yield curve will steepen. It's now in the process of completely disinverting. It should steepen within the next few months. Actually, if I was honest, I would move that towards the more likely, not the less likely. We do believe that rates will come down mid to late second half of the year in the US and that Europe will follow. I'm beginning to be a little bit less convinced for that latter part of the statement, to be honest. That's why it's in the less likely category. Europe has lower inflation and growth issues, especially around Germany. And the ECB has been pretty dovish. So although I still believe the ECB doesn't initiate rate cycles, the rate cut cycle, still I wouldn't be too surprised if they began some rate cuts in the summer. I know Santiago is on that camp. And finally, and that's the biggest bet of all, we think that slightly more likely than not that China's economy, but ever so slightly, that China's economy will rebound. The Chinese are pumping a lot of money into their economy. I know you all heard the Evergrande news this last couple of days, but we do think, and we have seen some encouraging data, that the overall economy is improving. Now, in terms of risks, and can we go to the next slide, please? So what are our major risks? What can upset our projections, which is for a bullish stock market as long as we get decent rate cuts, and the end of quantitative tightening, and slower growth for now, no recession really, but and improved growth in H2. So all in all, really optimistic stuff. What can go wrong? That inflation becomes sticky, and that's mostly down to energy prices. That geopolitics takes another turn for the worse, whatever that might mean. And in that particular group of risks, what this will mean for European cohesion, which is becoming an issue. You all see the standoff now between the EU and Hungary. Another risk would be a global recession or the Chinese economy deteriorating. There are a lot of things we don't know about China. So we depend on the numbers we're given, but who knows what's going on under the bonnet in this economy. So we could get a surprise there. That's why this is one of our key risks. And some of these include a credit event, a global real estate squeeze, a liquidity squeeze, or the increase of corporate debt and defaults. These are our key risks. Brexit, the pandemic, tech regulation, aren't really that big risks for us right now. Technological disruption is up there in the key risks, but it is also an opportunity. AI, creative destruction, as they call it. Now, for my final slide, I want to touch upon the key risk, which is geopolitics. This is what we have for 2024. As we said, two major wars, the Ukraine and the Middle East. And I don't think, I think they are linked in a way. We have the US election, the risk that everybody watches. If I'm being honest, I think it matters less than we think. Both assuming Mr. Biden and Trump are the final pair, which I'm not too sure that this will happen, the Democratic National Convention could hold surprises. But let's assume that it's Trump versus Biden. It's not, it's a more difficult decision than you might believe. Both presidents are fiscally expansive. They don't care about debt. They want to expand the deficits and grow the economy. Both presidents are America First presidents. Mr. Trump was very vocal about it. Mr. Biden crafted rules that were very friendly to move factories from Europe to the United States. Both of them have a very hard stance on China. And both of them are not really, that hot about international trade. A lot of people in the Biden administration recently quit because they felt that they were going nowhere with forging new trade deals. Okay, so the differences are not as heavy as you would think, at least for the shorter term. The longer term implications are a different story, which we really don't have the time to get into. We have the UK election, possibly near the end of the year. We should start considering the possibility of a change in government and what this will mean for taxes, what this will mean for the proximity with the EU. But I want to emphasize the word possibility. We're very far off from the elections, and things may happen. So, we should not consider this. We should not consider the electoral result in the UK is a sure thing. We have European Parliament elections, which you might think are insignificant, but I think in the next few years the Parliament might play an increased role, especially if Europe sees Trump, a hostile Trump on the other side of the Atlantic, and it wants to forge its own identity. So keep your eye on that. And finally, we could have a German election because the coalition there is feeling a little bit shaky. I'm not saying we will, but it's definitely, that's why the question mark, but it's definitely on the table. And if you get the German general election, that you have very big changes in the in the way Europe behaves, because Germany is the centerpiece of Europe. So with these thoughts, I will yield the floor to my Argentinian colleague, Mr. Rossi.
Thank you, George. I'm Santiago Rossi. I'm a senior economist at Mazars. I joined the company in 2022 and I cover mostly the US and European economies. Today I'm going to talk about our outlook for the global economy in 2024, and I will also give our views on growth, inflation, and interest rates for this year, and a medium-term view that we have of the economy. We think we are entering a new era of macroeconomic volatility, of higher inflation than in the previous decade. So I will present some of that today. So to begin, in this slide, I present two charts. The chart on the left has the consensus forecast for the US economy over the past 3 years. The dark blue line are the forecasts for the year 2023. And as you can see, over a year ago, the consensus of economists expected growth to be slightly below 1%, and that included a mild recession between the second and the third quarter of 2023. Eventually, as the data came stronger than expected, forecasts were revised to the upside, and we ended up with a forecast of 2.5% growth on average in 2023, which was what eventually was released by the BLS last week. What we had was a very strong US economy with a very resilient consumer, and most of the sectors of the economy recovering by the end of the year. Some of the sectors that were weaker, like real estate, housing, and manufacturing, pick up eventually, and we ended up with a very strong growth number. For this year, the momentum that we have in growth, we think will continue. The IMF currently forecasts a 2.1% year-on-year growth in 2024. And for the euro area and the UK, we think the economy and also the IMF sees the same, much weaker growth. The UK is expected to grow just 0.6% this year, while the euro area is expected to grow 0.9%, with the largest economy, France and Germany, doing much around 0.5%. Next slide, please. Why we think the US economy and generally most economies will avoid recession? We see a very strong consumer ahead. I mean, we think the US consumer will continue to perform very well, basically because we see inflation coming down and real wages recovering, and that's what we present on the chart of the left, which are real wage growth with a year-on-year basis. And as you can see, in most regions, real wages are already growing in real terms, and we expect this trend to continue. In addition to that, in particular in the US consumer continues to have significant excess savings. The chart on the right are the money that the US households have in their checkables accounts, and it's around, the last number, it shows that it is around 4 trillion. That is around 3 trillion above what they have before the pandemic. So they still have significant consumption power on their hands to continue for consumption to continue to grow this year. Next slide, please. In addition to the strong consumer, we also are having a significant fiscal stimulus on the side of governments. In the chart of the left, we are showing the US government spending in US dollars. And what you can see is that since 2017, when Trump was elected, government spending has been steadily growing, even under both Republican and Democrat administrations. Last year, in 2023, year-on-year growth of spending was 4%, which was the highest growth rate since 2022. Since 2002. So, I mean, and we see this trend continuing forward. The US announced just with the Biden administration the Inflation Reduction Act and the CHIPS Act, which are packages to reorganize the economy on the face of the challenge of the emergence of China, but we also see a significant stimulus to transition the economy to a more, to stimulate greener sectors, and all of that is also stimulating the economy to higher growth this year. It's not surprised that with higher government spending and not significant increases in taxation, the US public debt is increasing, and that is what we are showing in the chart of the right. Basically, what this chart shows is the rate of growth of the US debt, and as you can see, it is growing at the highest pace ever if one excludes the COVID year. So that is another source of stimulus. Next slide, please. Regarding that's our view on growth. We are very positive. On inflation, we're also optimistic. We see inflation coming down both in the European continent and in the US. We think in the US we could see inflation at around 2.5% by the end of this year, and also in the UK we also think 2.5 is it's a possibility to be reached by December of this year. In the euro area, we are, I wouldn't say more optimistic, but we think inflation could be even below 2% given the weakness that Germany and France are going through lately. But when we look to the headline inflation figure in detail, we notice that there are different trends going on there. On the chart of the right, I present the year-on-year inflation divided between goods and services. The light blue line is the goods inflation, which is around 0% year-on-year, and it's very close to zero. But the golden line, it's the services inflation, and that is growing at a rate of around 5% year-on-year. So there's a very different story between goods and services, and eventually the key to see inflation coming down, we will need to see services inflation declining. But we are optimistic on that side. Next slide, please. Basically, these three charts show why we think services inflation will decline. The first chart on the left shows the relationship between wage growth and services inflation. We think if we see a looser labor market, wage growth will slow down, and that will eventually push services inflation lower. The chart in the middle shows different labor metrics for the US. When all these metrics point to a looser labor market, but even though they are US figures, the same story can be said about the euro area and the UK. And basically, when you have a looser labor market, wage growth tends to slow down, and that is what we show in the first chart on the right, which is the relationship between the quits rate and wage growth. Usually, the quits rate leads wage growth with 9 months in advance, and that is consistent with a wage growth. The current figures that we see are consistent with wage growth growing at around 4%, which is consistent with the central bank's target of an inflation close to 2%. Next slide, please. So basically, that was our view on inflation. We are very optimistic, but on the back of that view on inflation, we think there is a space for central banks to reduce their interest rates this year. And the two charts show what the market is pricing at the moment. On the left-hand side is basically the interest rate of the bank, the US Federal Reserve, the Bank of England, and the European Central Bank. The consensus and the markets are pricing currently around 5 rate cuts by the end of this year, with the first rate cut starting in May of this year. We are not that optimistic. We think there will be fewer cuts and they will come later in the year. But nonetheless, we think that the disinflation will allow central banks to reduce rates nonetheless. Next slide, please. Well, the risk to these are the two main risks that we have for our scenario. The first one is further weakness in the Chinese economy. As you all know, China is going through a real estate crisis. The real estate sector accounts for around 30% of the Chinese economy. So when you have lower prices and lower investment in that sector, that basically depress the whole economy. Last year, the Chinese economy managed to grow 5%. This year is expected to slow down a little bit. But if it slows down much more than what is expected, that could impact on the global economy, particularly in other Asian economies, but also in Europe, and in particular in Europe, in Germany, which is more exposed to Chinese demand. And the second source of risk that we see are supply chain problems. Basically, what we are seeing in the Middle East, it's increasing container freight cost. Currently, they have increased 100% year-on-year in the last month, and that has an impact of around in 9 months ahead. But if we don't see a solution to this conflict in the coming weeks, that could impact inflation, particularly the European consumer. It is estimated, the IMF estimates that a doubling of shipping costs can increase inflation by 0.7% in the year. So that is another source of risk that we should monitor, that could change our view or our base case scenario. Next slide, please. So that was our view on the economy for the short term. With our medium-term view, as I said, we think we are entering a new era in macroeconomics that will be very different from what we saw in the previous decade. These are 5 key themes that we think will determine the behavior of the economy in this decade. These are structural labor shortages, geopolitical fragmentation, supply chain reshoring, more extreme weather patterns that could impact on commodities, and a more expansionary fiscal policy. All these themes point in one direction, which is higher inflation and more volatile growth, but also it could lead to higher growth. And this has significant impacts for investors, we believe. Next slide, please. These two charts are just a way to illustrate that. The chart on the left is the vacancies per unemployed, but indexed to December 2019, base 100. And what you can see is that we are currently have much more vacancies per unemployed than what we had in the previous decade. It's a way of showing the tightness of the labor market. On the chart of the right, we show the number of trade restrictions. As you can see, in the previous decade, we had around less than 500 restrictions, and now we are around 3,000. So we have the relocation of production of global supply chains will lead to higher prices. A tighter labor market will lead to higher wages, and all of that point to higher inflation. Next slide, please, and almost the last one. Higher inflation and higher growth usually leads to higher long-term yields, and that is what we show on the chart. The light blue line is the US nominal GDP growth, and the dark blue line is the US 10-year, the yield on the US 10-year bond. And what you can see is that they tend to correlate a lot. It makes sense that the yield of the US 10-year is mostly determined by nominal US GDP growth. And also another factors, but they tend to correlate a lot. So what this means is that with the current level of inflation that we see is stabilizing in this decade, we think the 2% that was a roof in the 2010s now would be a new floor, and that the 10-year should stabilize around the 3.5%, but probably it will be a step above that, like 3.5 will be the new floor for the 10-year rate. That should lead to higher inflation, should lead to weaker stock bond correlation, so that the mix of assets in the vehicle in the portfolio should change. And also, we think that higher interest rates and all these themes that we presented in the previous slide the investors should change their sector and geographical exposure based on these themes and prioritize the topics that we highlighted, like globalization, supply chains, green transition, and commodities to have a good performance in the coming decade. I mean, in the current decade. And next slide, please. So to summarize my presentation, we do not think there will be a recession anytime soon. We see a very resilient consumer ahead, and most economies avoiding recession, both the US and Europe. We think markets are somewhat optimistic regarding the interest rate cuts, but we expect cuts, but fewer and later in the year. In the short term, we see inflation interest rate coming down, but in the medium term, we have a view that inflation could stabilize a step above what we saw in the previous decade. We think 2% is the new floor, and it will be probably closer to 3%. And with a medium-term view, we think this new macroeconomic framework, this configuration, will lead to lower bond and equity returns correlation, and an investor should position in sectors and geographies that are in line with this view of where the economy is going. So thank you, George. That is the end of my section.
Thank you very much, Santiago. So, conclusions. Number one, equities and bonds have had a good run, but a lot of the good news is priced in. So we expect to see the ending of quantitative tightening and some good news from central banks before we start calling a bull market. For equities, the key question is, will the rest of the market catch up to tech, or will tech continue to lead everyone in this very narrow leadership rally? And for bonds, the question is, when will rate cuts begin? Because a lot has been priced in that may not necessarily transpire. And also, how sharp will they be? Okay, David Baker, our Chief Investment Officer, who's not with us, unfortunately today, did mention to me that rate cuts tend to be very sharp. You know, they're not incremental, and that's usually after a crisis or an accident. So it's a question of how sharp will they be, and this will matter a lot to consumers. Volatility is our key theme for the year for both markets and the economy. It's not that we're super bullish or super bearish or anything. We think that things will jump up and down, both markets and the economy. Still, we do believe that we will see interest rate cuts this year, possibly later than earlier. And we are not in the camp that says that the global economy will fall into a recession. We are not even sure it will see a soft landing or a landing at all. You know, Europe is one issue, and the UK definitely is growth is very slow. But in the US, things are strong, and in Asia, they're also looking better. So with that, thank you very much, Jordan, for the slides. I think we can initiate our Q&A session. And the first question I have is for Santiago. Santiago, you may not know this because you live in Berlin, but in the UK, there are a lot of strikes. And people are worrying that those strikes will increase wages and therefore feed into inflation. What's your take on this?
Well, you know, George, here in Berlin, we have also strikes. The Deutsche Bahn, which is our national train company, is also striking has been striking this week. As I said, we think the developments in wage growth are the key to see inflation coming down. So it's a very relevant question. On this, I would say that we have seen wages peaking in June of last year, so they have been slowing down a little bit. Wage growth is currently around 6.5% year on year, and it was above 8% 6 months ago. As I show in the slide, basically we think that a looser labor market tends to lead to lower wage growth. There could be noise, obviously, but I think we think that, at least I believe that the trend is clear that the labor market is getting looser, unemployment has been increasing. It was a minimum of 3.5 in the UK, and now it's closer to 4.3%. So it is a slow process, but wage growth is slowing, and that eventually is why we think inflation will come back to target.
Thank you, Santiago. And next question that has come through, and I will attempt to answer this. We have time for one more question. Is when will the Bank of England cut rates? The answer is that the Bank of England itself, to be perfectly honest, does not know when it's going to cut rates. Okay, right now it sees inflation coming down, but wage inflation is still at 6.6%, and it sees the price for commodities going up, so it does see the potential for volatility. So the long and short of it is, because they're data dependent and data is still volatile, even the Bank of England, if you ask them honestly, they wouldn't be able to answer, because they're looking at the data as much as we do. Now, our best bet is at some point after September, October, we'll begin to see rate cuts in the UK. But that's, again, it's not a very high conviction call, because, for example, if geopolitics flare up again, then inflation could possibly persist. So it's not in our hand to to make an accurate prediction, or even in the hand of Bank of England to cut interest rates. It depends on inflation, and as we said, as volatility is our key theme for the year, volatility, not linearity, but volatility. We can say after September, but it still depends on a lot of factors. And with that, thank you very much for attending.